What is fueling higher bond yields? Some experts point to massive fiscal stimulus, strong growth rebound, inflation fears and expectations, and eventual tapering or taper tantrum as they coin it sometimes. They're also saying the Federal Reserve has little control of the bond market at the moment. It has. That's what they're saying. That the bonds is the bond yields are escaping them. They definitely have no control over it, and obviously they are, you know, moving up. The yields are moving up. The Federal Reserve is looking at employment figures, whereas the market or its participants is are looking at GDP figures. So if they are looking at GDP figures, they are looking at obviously strong growth, rebound, and inflation expectations. So that's, amongst other things. So this has fueled the sell-off amongst other things. So there's a limited chance that the Federal Reserve will reverse policy at the moment. So it could come in and buy at the long end of the curve, that is long-term bonds. Currently, there is not a lot to really fear about, because we know that yield minus inflation is currently negative. It is when it reaches zero and approaching two, then we are, that's when we have to, we have to worry, because this is a policy they set. They said, they don't want inflation to go beyond 2%, and then if that happens, then there's trouble, and then if there's trouble, then they're probably going to taper tantrum, and but we're not there yet, but the market is, they are piecing the parameters in this whole scheme of the mechanism of the whole structure, and they are. This is what they are running helter skelter about, and some have actually cited the fact that the bull market is about $25 trillion. That is where everything that supports all of us, all over the world, directly or indirectly, remotely or remotely, lies. $25 trillion. If that's where to see a sell-off, then that's something you really have to worry about. COVID, according to them, is nothing. That it will be calamitous. But of course, they're also saying that if anything goes wrong there, it may well be just in the short term. So, obviously stocks are being challenged for what we have pointed out by bonds as 10-year rates top dividend yield. They have surpassed dividend yields, the S&P dividend yields. Stock market participants are trying desperately to decipher what the rise in bond yields will mean for the market. Since February the 10th, 2021, 10-year Treasury yields have moved from 1.13% to as high as 1.61%, currently 1.614%. This is the highest level since February 2020. The spike put a benchmark rate above the S&P 500's dividend yield, which stood at 1.43%. So when they're looking at this now, they are worried. They're getting worried. Because it's because it's based on this structure that the S&P dividend yield should be at least above the original 1.13% that it was as at February the 10th, at least early this year. Fears of inflation is causing investors to speculate the Federal Reserve may shift policy, but we've pointed out that that may not really happen. That is not really, and it's just worries that market participants have, and unfortunately, this is I mean, this is the reality. The policy could be one, but the actions of the market participants is another thing. Many strategists cite the surging yields as a culprit for the weakness in the in tech stocks, as well as the heightened volatility in the broad market. High rates could hit growth-oriented technology sector especially hard, as it has benefited from easy borrowing. Yields continued their rally even after Federal Reserve Jerome Powell downplayed the risk of inflation, saying it could take 3 years to reach the central bank's target consistently. He said that inflation was still soft and that the central bank has the tools to fight it if it should. And then the chief global macro strategist at Net Davis Research says the rise in yields has primarily been driven by rising inflation expectations. More recently, expectations of better economic growth down the road have pushed up real yields and increased inflation and liquidity premiums. So it is definitely people who are panicking and pushing things around. So yes, this to some extent could be why we are having higher bond yields. What I mean, we'll be able to try to point out what is fueling the higher bond yields. Okay, so if you're new to this channel, subscribe, like, and share. If you're already a subscriber, thank you very much for watching this video.